and we're here to discuss today what is the difference between a VUL and a traditional life insurance. So I have this client, he's a longtime friend of mine. I met him in one of the pageants I joined in. And he's asking me, Carl, what's the difference between traditional life insurance and VUL? Why would I prefer one over the other? And he asked me, Carl, give me options. I want to know what's the differences, how much I would pay for, and what's the functionality of each. So with that in mind, I'm creating this video so that I can share this to my client and maybe to everyone here as well who's curious what's the difference between a traditional life insurance and a VUL. Let's get started. Number one is a traditional life insurance. A traditional life insurance is life insurance alone without any kind of investment portion. It has a cash value that you can loan. So for instance, you have to pay 2,000 pesos per month for 10 years. And after 10 years, your insurance coverage for life will be done. It's completed. So you will get maybe 1 million of sum assured when you die. And that's it. So now, if you wanted cash or if you needed cash, you can surrender your policy and get the cash value of the traditional life insurance. Hence, this is what happens when a traditional life insurance is being encashed. First, your coverage will now be closed. So what does that mean? It means that if you die anytime soon, you won't receive the 1 million pesos sum assured because you already encashed it. So let's say you paid 2,000 per month for 10 years. That's 2,000 multiplied by 12. That is 24,000. Multiplied by 10. That's 240,000. So in the whole term of your life insurance, your traditional life insurance, you paid 240,000 premiums. And the cash value would most probably be around what? 1/3 to maybe a half of that. So let's say you can get 150,000 cash value if ever you wanted to surrender your policy after the 10-year period. So you would think, I think I got it on a bargain. You would think, that's an advantage. If ever I want to stop my insurance, then I could get 150,000. But then again, you think of what you would be losing. Just imagine, if you died anytime soon, you would have gotten, your family would have gotten 1 million pesos. But since you wanted to surrender the policy, you only got 150,000. So technically, you lost around 850,000 in the process because the promise of the insurance company is 1 million when you die and you got their other promise which is 150,000 right now when you're alive. So it's up to you how to manage it. At the same time, if you didn't want to lose your coverage but you really needed money, what you can do is to get a policy loan. So let's say you have already invested 240,000 and that's the cash value is 150,000. Maybe around 80% of that you can take out as a loan with the interest rate of around maybe 10% per annum. So just imagine, it's like you had an instant bank that you can loan from, but it's a loan. You would have to pay it back. Else, the interest charges will be charged against your policy. What will happen now is you can lose the coverage later on. So now, let's talk about VULs. VULs are also called variable unit-linked life insurance policies. So why is it variable and why is it unit-linked? Variable because you can update the details of your policy. Unlike a traditional life insurance, it's already fixed. This is your contract. This is what you pay for. This is what we give you. Okay, and that's fixed. But with the variable universal life insurance or variable unit-linked insurance, what happens now is you can update how much your premiums are. You can update how much the sum assured is, how much your critical illness coverage is. So things like this. You can update this at any point in time. And secondly, what does unit-linked mean? Unit-linked means you're buying units of an investment. You're buying units of a fund. Let's say Carl's fund. Carl's fund is being invested into company X, Y, and Z with bonds X, Y, and Z. So meaning you have ownership, a part ownership of Carl's fund, and any profits on Carl's fund, you get added to your fund value. At the other side, if Carl's fund loses because of the trend of the market, then your investment would be affected. It would lessen. So in short, the key difference between a VUL and a traditional life insurance is the investment portion, the risk that is involved with investing your funds. So now, a VUL has fund value in contrast to the traditional life insurance with a cash value that you can take out. And when you surrender your policy, they give you the cash value. In a VUL, you have a fund value. You have your insurance coverage and you have your investment portion. This investment portion is your money. When you say fund value, this is something that you can withdraw at any time. Meaning, if for instance, you needed money, in the previous previous instance, we mentioned 2,000 per month for 10 years. But in a VUL, it's usually much higher, maybe twice at the very least. So let's say 4,000 a month. 4,000 a month times 12 is 48,000 pesos. Times 10 years is 480,000 pesos. So VULs usually have twice or more premiums to pay because of the investment portion. But the good thing about VUL is that you are already accumulating wealth as time passes by. A traditional life insurance doesn't accumulate wealth for you. The cash value is just the means and method so that the insurance company can cancel out their obligation of paying the higher sum assured. So in VUL, the company is now covering you still with the sum assured, which is much higher than the traditional one because you are paying higher premiums, higher coverage, higher protection. And the fund value you can get at any time. Let's say you already had a fund value of 440,000 for after 10 years of putting in your premiums. That 440,000, maybe you have to leave 20% or so. You get 80% out and withdraw it. That's your money. It's not a policy loan. There will be no interest charges on that. And the coverage remains. Still, you will get the sum assured when you die. And you still get all the critical illness benefits, the personal accident benefits, and all the riders that come with it. So if you look at it, VULs might sound more expensive, but in the long run, it helps you accumulate more wealth so that you can build up your portfolio much better. And I'm not saying that you should only invest in VULs. Of course, you can diversify your investments. But the good thing is, before investing in property, in mutual funds, and other kinds of investments, you have to at least cover critical illness coverage, personal accident coverage, and total and permanent disability coverage so that when these things happen, your other investments won't be impacted. Let's give a scenario. A has a VUL or a traditional life insurance with a critical illness coverage of 2 million, while B doesn't have, but he has investment in real estate. Let's say a 2 million house. So after a month of getting the VUL, A suffered from cancer and was diagnosed with terminal cancer. The insurance company will provide the claims, which is 2 million critical illness coverage. While B, on the other hand, suffered the same fate and he didn't get insurance, but then he has real property worth 2 million. Now, what will B do? A will just get the claims and continue paying the premiums as it is. Continue investing as it is. But B will suffer heavily. What he will have to do is to liquidate his real estate investment because he will have to pay for the medical expenses. And then after that, he will have to start from scratch, from zero. So if you have the chance and the choice to choose, would you be A or would you be B? I hope this video has proven to be of value for you guys. If you have comments, please put them down below. And this is still my content creation building confidence stage. So I hope I'm still adding value at this point in time. So see you tomorrow. Invest in tomorrow. PH.